Well, good afternoon, everybody. My name is Paul Bodicher. I'm the Director of Media Relations here at the Bank of Canada, and I'll be moderating this afternoon's press conference. Governor Macklem will be pleased to take questions for about 20 minutes. Just to clarify how this will work, we have reporters here in the auditorium. We also have some on the phone line. So we'll start with the first round here in the room, and then we'll go to the phones. For the people here in the room, I'll ask you to turn your microphone on and off at the appropriate time by pressing the button on the microphone in front of you. And I'll remind people on the phones to mute their line if they're not asking a question. You can do so by pressing *6 and unmute by pressing *6 again. And if I somehow fail to do so, I'll ask you to please identify yourself when I call on you, and please feel free to ask your question in either official language. Avant de poser une question, veuillez vous identifier et libre à vous de poser vos questions dans la langue officielle de votre choix. Pour mettre votre ligne en mode discrétion, appuyez sur étoile 6 et pour l'enlever, faites étoile 6 encore une fois. So we'll get started now with our first question here in the room, and that is Julie Gordon from Reuters.
Hi, Governor. Thanks for taking our questions. CPI common hit 2% for the first time since 2018. We saw that data this morning. Is this a sign that there's not much slack left in the economy?
Well, as you indicated, first of all, total CPI inflation came out 4.7%, same as October, clearly well above our target and above our 1% to 3% control range. If you look at the three measures of core, overall they didn't really change much. Common up a little bit was 1.8, it's now 2. The other two, one was up 1.1 and the other was down 0.1. I think what you're seeing overall is that the significant amount of slack that we did have in the economy is substantially diminished.
Okay, we'll go now to Kevin Carmichael from the Financial Post, please.
Governor, your rhetoric around inflation has shifted quite noticeably over the past number of weeks. Yet if you look at the inflation numbers, is inflation essentially being driven by things that monetary policy can't really do much about. So you could elaborate on what you think that you can achieve?
Well, last week we put out our policy statement with our decision, and I think we were quite clear. The economy, we had strong growth in Q3. The economy is showing good momentum in Q4. Looks like it's going to be another strong quarter. We've seen strong job growth, employment last couple of months, impressive job gains. Employment rate now back essentially to pre-pandemic levels. What that suggests is that the recovery is well advanced. At the same time, inflation is running well above our target, as we've just discussed, 4.7% this morning. And we've indicated that we expect it to stay elevated through the first half of next year before easing in the second half of next year towards our 2% target. And my colleague, Tony Gravel, Deputy Governor Tony Gravel, in his remarks last week, really, I think, provide a fairly detailed analysis of how global supply chains, or really how the strength we're seeing in global demand for goods is interacting with impaired global supply chains that has pushed up the prices of many globally traded goods. We do expect that to ease. There is some uncertainty as to how quickly that's going to happen. I mean, clearly, it's going to take some time. There is a backlog of orders. It will take some time to work through that. We do think that those will ease off and inflation will come back down, but there are some risks around that, as Tony outlined. Yeah.
Okay, our next question here in the room is from Greg Quinn of Market News.
Hello, I was wondering, since on the way into the pandemic, the bank several times cut interest rates by half a point instead of the normal quarter, if there's a symmetry there on the way back up, given elevated inflation, that a half-point rate increase would be worthwhile.
I think we went into this all of a sudden. Suddenly the world was hit by the pandemic. That required a very rapid and very bold response, and that's what you've seen. I think what we're focused on now. We ended QE. That is putting the focus on when are we going to remove our exceptional forward guidance and raise interest rates. We have become more data dependent. We are looking at assessing the diminishing degree of slack in the economy, and we're focused on bringing inflation sustainably back to target. As we mentioned on a number of occasions, we are closely watching inflation expectations and wage costs. Keeping inflation expectations well anchored is key to getting inflation sustainably back to target.
Okay, we have one more question here in the room before we go to the phones, and that will be from Jordan Press of Canadian Press.
Good afternoon, Governor. In your speech today, you talked about trust. And I wanted to ask you about that because over the last number of months, obviously, there's been some questions about how much Canadians still trust the Bank of Canada to manage inflation. I know you've talked about this, but I'm curious about how you see not just maintaining trust, but maybe rebuilding some of it, given maybe that your definition of transitory is different than what Canadians see, and also at the same time when you may be under more fire for being politicized because you're now also more formally taking a look at the labor market as part of your inflation targeting regime. So I'm wondering, how do you not only you talk about maintaining trust, how do you also rebuild it after this?
Jordan, trust starts with a clear mandate, and it's reinforced by transparency. And I think this agreement, is very clear that our primary focus is price stability. The target continues to be the 2% midpoint of a 1% to 3% control band. The agreement also clarifies that we do have a role in supporting employment. It's also very clear that because well-anchored inflation expectations are critical to achieving both price stability and maximum sustainable employment, the primary objective is price stability. So what does that mean? Simply put, what it means is that price stability is job one, because if we don't get that right, nothing else is going to work. And this mandate, it's the mandate we need right now as we reopen the economy and bring inflation sustainably back to target. And it also is the mandate that we need for a variety of things that could happen in the future. It's a 5-year agreement. We need to think about what else could happen. And I think this mandate is very clear on how we have used the flexibility effectively in our framework to manage risks and bring and control inflation. And it clarifies and ratifies what we've been doing on how we can use that flexibility going forward to manage those risks and achieve our mandate. So that's how we're going to maintain trust.
Okay, we're going to go to the phone lines now, and our first question will be from Shelley Hagan of Bloomberg News.
Hi, Governor Macklem. I'm curious how you're assessing the current labor market conditions right now. Would you say we are at maximum employment?
Well, first, Shelley, I understand you're off to a new assignment, so we're gonna miss you here, and I can't imagine what could be more exciting than monetary policy. But I do want to thank you for your careful reporting. The labor market. as I mentioned in response to a previous question, the labor market has come a long way back. Roughly around the time I started as governor, there were more than 3 million. We lost more than 3 million jobs. Those actually have more than come back. The level of employment today is above where it was pre-pandemic. The employment rate is roughly back to pre-pandemic levels. We have created a broader dashboard of labor market indicators, which we put on our website. And what you can see from those is that they've all come a long way back. Some are back, some are not quite back. But there's no question, to a significant degree, the slack in the labor market has been absorbed. And we're still seeing fairly high vacancies in the labor market. So that does suggest there is continued demand for labor in the economy.
Okay, we'll move on now to Mark Rendell of the Globe and Mail. Mark.
Hi, Governor. Can you hear me?
Yes, Mark. Go ahead.
Excellent. So I've often heard flexibility kind of described as the secret sauce of the inflation targeting regime. It allows you to manage risks and deal with policy in a flexible way to address multiple things. Now, it seems like with the new mandate, you're adding kind of specific language around how you're going to use that flexibility, focusing on labor markets. And I'm wondering, is the new mandate less flexible by adding language and specifying, when you're going to lean into the flexibility? Does that reduce the flexibility of the framework?
I think what this new mandate does, this new agreement, it really ratifies the flexibility that we've been using. And I think it does more clearly articulate the situations in which we would use that flexibility, the situations we found it particularly important to use that flexibility. It articulates how we'd use it. It also articulates how we will be transparent about when we're using it. And that we will tell you when we're using it. You'll see it in our inflation forecast. We will discuss it as we assess incoming data relative to that forecast. So, really, the message here is we've been inflation targeting now for 30 years. We've learned a lot about how to use this regime effectively. I think what came through from our comprehensive review is it's very hard to do better than inflation target, both in theory and in practice. And it does we do articulate clearly where that flexibility has been, and we think will continue to be particularly important in managing those risks and achieving our mandate.
We will go now to Tony Mace of Mace News.
Hi, Governor. You've been saying that the flexible inflation targeting mandate allows you to use forward guidance to hold rates low for longer, even if that means inflation is overshooting. But now with inflation above the control range, do you still have that flexibility, or is it time to move on from that forward guidance?
Well, we indicated last week that it's not time to move off that forward guidance, but clearly that time is getting closer. This economy has come a long way back, and as I mentioned, when the economy was in a very deep hole, it was clear that a lot of stimulus was needed to get it back. As we've come back, we have adjusted that. We tapered our QE, we ended QE, and now the focus is really on the conditions in our forward guidance. And as I mentioned, we've become more data dependent. We're assessing the diminishing degree of slack in the economy, and we're very focused on bringing inflation sustainably back to the target. I guess what I would stress is that this new mandate does not change our sort of current approach to monetary policy. We have, through this whole crisis, we've been very focused. Inflation has been our beacon. We have been spending a lot of time analyzing the labor market. The effects of the pandemic on the labor market were tremendously uneven. As the labor market has recovered, actually that unevenness has really diminished substantially. The most affected groups have been drawn back into labor force, have got back to work, particularly through the summer and the fall. So, just to underline, this agreement really doesn't change our current approach to policy.
Next up, we will go to Paul Vieira from the Wall Street Journal, please.
Governor, you said in the audience Q&A that, and you repeated again, may have repeated again that, bank officials are not comfortable with the level of inflation. If you're not comfortable, then why aren't you moving ahead? Why aren't you pivoting to doing something else?
First of all, we have taken action. As I mentioned, we tapered and then we ended QE. Look, the challenge here is to bring inflation back to target without choking off the recovery. We do think there are good reasons why we think that the inflation that's coming largely from sharp increases in global goods prices will ease as we get into the second half of next year. And the reason for that is that this reflects the very unique circumstances of the pandemic. Because we can't consume all the services that we would normally like to consume, households have shifted into buying more goods. And that's not just happened in Canada, that's happened around the world. This is a global pandemic. But at the same time as global demand for goods has really surged, global supply chains are still impaired. They're gummed up. And that's the virus has affected. It is closed plants. It's slowed production. There are shortages of ships. Goods, unlike services, need to be physically shipped and delivered. That has all. It's meant that there have been delays in getting goods. We're seeing that in the real economy. You see that in some parts of consumption. You see it in investment. You see it in our exports, particularly of cars, where the shortage of chips is affecting. You also see it significantly in inflation. But we are seeing considerable focus on logistics, on improving global supply chains. It is going to take some time. As I mentioned earlier, there's a backlog. But we do expect we will work through that in the same way we've worked through every new issue that this pandemic has put forward. So there are good reasons to believe that inflation will come down. Really, to go back to one of my previous answers, we are focused on the conditions in our forward guidance, the diminishing degree of slack in the economy, and what it will take to bring inflation sustainably back to target.
And we'll take one final question now, and it will be from Dave Parkinson. Dave, please go ahead.
And I remembered to unmute this time. Thanks, Governor. Good to talk with you. I wonder if you can just maybe walk us through where we're going from here in terms of the line of succession, maybe, for lack of a better term. Are we likely to see, based on what you've told us about your focus on the forward guidance, are we likely to see forward guidance changed or dropped from the statement before we see a rate change?
Dave, I think you'll understand. I'm not going to speculate. I think, look, there's, there's, you need to remove the forward guidance, and you need to decide whether it's time to raise interest rates. We will be watching the incoming data very closely, and when we get to I think it's January 26th is our next decision. At that decision, we will have a full monetary policy review report. So that will include an updated outlook for the Canadian economy, our updated views on the risks, you know, what I can assure you is that we will provide the appropriate amount of monetary stimulus for the economy. This mandate, I think, makes it very clear that price stability is our primary focus, and we will deliver on that mandate.
And that concludes today's press conference. Thank you very much, Governor Macklem, for joining us. Thank you to everybody here on the room and who dialed in. And let me just take the occasion to wish everybody a safe and happy and healthy holiday season. Take care, everyone.
Thank you all very much, and we'll see you next year.